Hi there, welcome to the first weekend general market update for the 13th of January. And the year has started pretty positively with good rises in global markets since the start of the new year. So let's get on and have a look at what's actually happened in the last week and a half. Just a reminder about the general advice nature of this information. So the S&P has risen substantially since the new year, up 65 points, which is roughly 650 points on the Dow, which is more widely reported, and that's a substantial rise in 10 days. And it's really as a result of the fiscal cliff fiasco coming to a conclusion, as it always was going to. Markets had priced in a certain amount of downside for that, and as a consequence rebounded quite strongly. So it's just another case of market noise that you've really just got to try and ignore. If you try and trade in and out on that sort of data, then it's going to be extremely difficult to make any progress. Now the S&P index is currently pausing at just under 1475, which is an expected resistance area where there's a double top. So we might sit there for a little bit longer, but it's still looking very positive, as you'll see from the chart shortly. Now the economic data globally continues to improve wherever you look, and I think 2013 is setting up as a very, very positive year. So on the S&P, I would expect to see a run beyond 1500 in the not too distant future. The ASX index, ASX 200 index, only gained 61 points in that same period from New Year, so really has been dragging the chain after outperforming. And I guess that's not unexpected because the banks had had a terrific run. BHP and Rio had rebounded but did give some ground on Friday, basically on some Chinese inflation data, which ticked up a little bit. The Shanghai Composite Index, as we'll see, has been a leading indicator for the terrific trade data results that came through last Thursday. Exports were up 14%, which is a very strong reflection of what's happening globally, because they can't increase their exports by 14% unless someone's buying it. So that's a positive. Their imports also improved 6%, which again is another indicator that things are picking up again in the domestic market as well. So pretty good news on Thursday. The inflation data did tick up on Friday, which caused a bit of a resource sell-off in our market, but again, I think that's probably just noise. So I'm expecting that resources should continue their rebound in 2013. And with the exception of coal, resource prices are pretty buoyant. We've got iron ore close to $160 a tonne, so it's nearly doubled since the low of only 3 months ago. We've got oil back up to the mid-90s. We've got gold still consolidating, but still pretty positive. We've got copper still pretty positive, and so it's really only coal that's really dragging the chain. Now the US dollar still in a broad range, and the downward bias still continues because really that's what the Fed wants. They want a lower US dollar to assist with their manufacturing exports, and frankly they need it. If the US dollar was to go back up into a bit of an uptrend, that would be very, very bad news for America. Now bond yields continue to shrink, particularly in Europe. The Spanish yield, you remember, it wasn't that long ago, it was over 7%, and people were talking about disasters, and now we're down into the 4% area. And the Italian yield is getting down towards 4% as well. So real indication that the panic and the really big problems in Europe are behind us now. Gold is still stuck in the trading range. The Fed minutes that indicated that they may stop the QE program sometime in 2013. I think there's a very high probability that it's just the Fed trying to talk the price of gold down, because I can't see there's any way that they're going to stop printing money for the next few years at least, and probably much longer than that. The gold stock indices, we'll have a look at those. And again, they're at a historic discount to the gold price. So I think the risk reward is certainly to the upside in terms of gold stocks. And there are a few signs of those gold stock indices turning up. Copper remains steady at 363. Oil has risen to 94, so back into an uptrend again. So things all pretty positive there on the commodity front. And there's the chart for 6-month spot copper. Now let's have a look at some of the charts. This is the S&P 500. So let's just pan back. We've got an all-time high up around about 1570 and some other resistance around the 1520 mark, but you can see there's really no indication that this this trend is running out of steam, and we're now up at a medium-term double top, and I would expect that we may just muck around here for a few weeks. The index is not particularly overbought, so I'm really expecting to see this level at 1475 break to the upside. The fact that we had very little pullback here, we had two huge rises, very little profit taking, and then the market started to move higher again. There was a little bit of an attempted sell down on Friday, probably in response to the Chinese inflation data, but basically the S&P ended up finishing flat on the session. Just while we're talking about China, this is the Shanghai Composite Index, which is the domestic market. You can see there's been a very, very strong rebound. Gave some ground on Friday, which is to be expected on that data, but I don't think it changes the overall trend. This is the US dollar index. As you can see, we've been in quite a substantial trading range from around 78 to about 82 for some time now. We're getting towards the bottom end of that range. There's been some sharpish moves over the last couple of days, and so that's going to be positive for stocks. Turning to the Australian market, this is our index. We've had an extremely good run since the middle of November, but really since the start of this year has really just gone sideways more than anything else. But in the short term, that's neither here nor there. So the Australian market's still looking very positive. If we look at materials, which is essentially BHP and Rio, again, very strong run. Went from around 9,500 index points to 11,000 points. His bit of profit taking came in, and I would expect to see this probably rebound fairly quickly. And finance has continued to remain very strong, as it has since the middle of last year. We had one period here of profit taking between the middle of October and the middle of November, but other than that, it's been a pretty good period for financials. Now let's have a look at gold. So first of all, gold on a daily chart, and so you can see we're still consolidating between around 1640 and about 1690. So we need to move above 1690 to indicate that we're back into uptrend again. But I believe that gold is probably based out now, and I'm expecting to see gold move higher over the next few months. Silver, pretty similar kind of pattern. It's just really consolidated over the last few weeks. And just looking at gold on a weekly chart to give you a bit more of a clearer view, you can see the RSI is relatively low. It's down around about the 44 mark, and really just it's consolidating around this 50% retracement, 61.8% retracement level. I would expect to see that this will be the base. Now let's have a look at the HUI index. You can see we appear to have based out now. It's had a couple of goes at moving higher, but it certainly looks now as though it's formed a base. If we look at the junior market, the junior gold miners in America, you can see here that we've formed a higher low, and all we need to do is just move a little bit higher. We just need to get above the high of the 2nd of January, and we'll have a higher high, and that of course constitutes an uptrend, and I think that would be the signal that that gold stocks, and particularly the smaller gold stocks, are heading back into uptrend. But if we look at the relative comparison between the price of gold and the HUI index, you can see that we had this is on a relative basis from 12 months ago. You can see that they were fairly close together back here in January of last year. We then ended up with we opened up a huge discount. The gold stocks, the blue line, opened up a huge discount to the price of gold. That closed again in the middle of the year, opened up again in July, and then really gold stocks really got a bit of a scurry on into September. But again, since September, gold stocks have gone off the boil again, and it's really hard to understand why that is. I've read some suggestions that it could be because people are putting money into gold ETFs now and trying to trade the price of gold through ETFs rather than through stocks. But there is a trend just starting up now with some of the better gold stocks now starting to pay dividends. And I think once that starts to work its way through the system and people start seeing gold stocks as paying dividends, whereas ETFs are not and gold is not, then I'm confident that we'll see gold stocks getting support again. So let's move on now and have a look at the overall strategy. The best trend over the last 6 months unquestionably has been stocks that are paying a good yield, particularly the non-resource stocks. So the demand for yield around the world continues, and I expect that that will be a continuing theme in 2013. But just a word of caution, many of these really good stocks are pretty fully valued, and some of them are getting to silly levels of overvalue. Now they're great businesses and they're going well and profits are moving ahead very strongly, but there is a point where you can just pay too much for these stocks, and if and when there is a turn, then you can see 20-25% cut off the value of these stocks pretty quickly. So just be careful about which stocks that you go into on that basis. The best value, unquestionably to me, selected gold producers. They are cheap, and this is very selected, but they are cheap and they are on a strong growth profile, and they've got no debt, lots of cash in the bank, and there's a lot to like about them as a business. Now I know they're out of favour with the market at the moment, but that will change. So the best approach, depending on the way that you want to trade and the sort of outcome that you're after, is really to strike a balance between the recovery of resource stocks, which I believe we're now in the early stages of, but recognising that they're going to be volatile or more volatile, and the lower return but reduced volatility of trading the non-resource opportunities. So it's really just a matter of striking that balance between the two that suits your particular needs. So that's it for this week. Talk to you again soon. Cheers.